Good morning, everybody. Thank you for attending the first of what I hope will become a series of topics that we'd like to do for legislators and their staff on local government. I think it's important that we continue to provide education on how county, city, and schools work in the state of Georgia, since so much of what they do obviously is impacted by the state legislature. And we've had several legislators that have come to us and asked for some additional training. We've chosen the first topic based on some of the interest we've received from various legislators on local option sales tax. It seems to be discussed a lot relative to tax reform. This year, as you know, there's discussions about a future sales tax for transportation. And so for some of those reasons, we've decided to start with this topic. So I hope this is helpful. As we go through the presentation, as Efrain has said, feel free to type in any questions you have in the chat box or hit the button to raise your hand, and be glad to address any questions you have. This should take no longer than an hour at the most, so we probably actually will be out of here before 11 o'clock. So with that, let's talk a little bit about why legislators need to know about local option sales tax. First of all, it's the second most used revenue source for both state and local government. As you know, the state relies primarily on the income tax, the personal income tax, and local governments rely primarily on the property tax. But the sales tax is a close second for the state, and it's a major part of the local revenue base. Legislators also set the rules for local governments and what local option sales taxes are available to them, what's the limit, what are the parameters that those taxes can be utilized. And so local governments really cannot do anything when it comes to local sales taxes without permission from the state legislature. There's also been a lot of discussion recently from legislators about moving more towards a consumption tax or a greater reliance on consumption taxes. I think there's a committee that's meeting in the Senate right now that's looking at moving more to a consumption tax and reducing our reliance on income tax. There's a referendum that will be on the ballot this November. It caps the rate for state income tax. There was some discussions previously about using sales tax to reduce property tax in the state of Georgia. So everybody seems to have a feeling that the consumption tax of the three major taxes is the one that's preferred, and they would like to utilize it more to eliminate as much reliance on the income tax and the property tax. So with that in mind, there's a lot of things that have to be looked at, and how do we expand the sales tax base or change the rate so it will generate the revenue that's necessary to replace some of these other revenue sources. Also, we have to keep in mind the impact that sales tax has on economic development. We have a lot of border counties or border communities. Obviously, some of the largest are Augusta, Richmond, and Columbus, Muskogee. Got Asta on the south end of the state, and then up in the north end, Whitfield County, Dalton, that area. And if we get too out of line with our surrounding states as it comes to rate or in things that we tax or don't tax, then we could force business to leave our state and go to other states. In other words, people, if the item is a big ticket item, may drive to another state to buy it. And we lose out on not only that revenue, but we lose out on the economic benefits from our businesses being able to sell those products. Right now, if you look at the surrounding states, we're pretty much in line as it comes to rate. Obviously, it varies by a couple percentage points when you look across the state line, but we're not low by any measure, and we're not high. So we're kind of right in there, and we're competitive as it currently stands. Also, the impact that we have with out-of-state vendors as the internet becomes more and more common tool to use to purchase products. We have to look at how our in-state businesses compete with out-of-state businesses. In other words, businesses that don't have any physical presence in the state of Georgia. Although the laws of the state of Georgia require somebody to pay a use tax when they are not required to pay the sales tax, in practice practice, it's almost impossible to police that and make sure that people are actually paying that use tax. So if you go online to say, eBay and make a purchase, they're not required to collect our state and local sales tax. However, you're required to pay the use tax, but most people don't pay that use tax. We've had some success in Georgia in going after out-of-state retailers and getting them to voluntarily comply. The most recent was Amazon. Amazon now is collecting some of our state and local sales taxes. But there's nothing that requires them to do that. Until Congress takes action on this, though, there's not much that we can do as a state. I think we've changed our laws to come in compliance with what we call streamlined sales tax and some other things to try to go after the online retailers. But the point is that as we are more and more a global society and people can buy anything from anywhere online, we have to really look at our rate compared to places that they can buy products with and avoid sales tax, because the 7% delta there is a major incentive for some people to go elsewhere to buy their products. So this morning we're going to talk a little bit about the different types of local option sales taxes that we have in Georgia. This is a map of the local option sales taxes that we currently have around the state. As you can see, there's quite a number of them. The most common ones are what we call LOS, local option sales tax. Those are the counties that are in green. And then we have SPLOS, special purpose local option sales tax. That's also a very common one. And then we have education SPLOS, which is the school version of the county and city SPLOS. So those three are the most common three local option sales taxes. And then we have a number of local sales taxes that are more unique just to certain counties. For instance, we have the homestead option sales tax. That one only exists in 2 counties in the state, in both DeKalb and Rockdale County. We have the MARTA tax, which only exists in 2 counties in the state, Fulton and DeKalb. We have what we call a municipal option sales tax for water, which only exists in one city in the state, and that's the city of Atlanta. It's the only local sales tax that's confined to a single city. All the other local sales tax are coterminous with county boundaries. Then we have a specialty loss tax that funds public safety operations, and that one is down in Columbus-Muskogee County. We have also a specialty loss up in Habersham County that's only charged on alcohol sales, and we have a specialty loss up in Towns County that's a second loss. They have 2 kinds of loss, an education loss and a county city loss. And we have 7 counties in the state, the ones with the asterisks beside them, like Houston County here in the center, Mitchell County and Colquitt County down in the south, and then up in the north we've got Chattooga, Towns, and Raven. They all have what we call an education loss. It works just like the county city loss does, except it rolls back school property taxes instead of county and city property taxes. And of course, since they're not splitting it between multiple local jurisdictions, there is no required negotiation for those education SPLOS. Those were done back when local constitutional amendments were allowed. That's how those were enacted. Those were grandfathered in, but any county or city that's considering one of those today would not be able to do it, at least through a local constitutional amendment. There would have to be a new general statute placed in law to allow for that. So let's start and talk a little bit about local option sales tax. This is the oldest one we have. Again, as you can see, most counties in the state have either a county city lost or education lost. There are most of the ones that don't have any kind of lost are right in the metro area. Cherokee, Cobb, and Gwinnett, they do not have a lost of any kind. And then DeKalb and Rockdale, as I mentioned earlier, they have a host which replaces their lost. They're not even eligible for a lost because they currently have a host. So really you only have 3 counties in the state that are eligible for another type of permanent penny. That would be Cobb, Cherokee, and Gwinnett. And then I told you Habersham County sort of has a specialty loss that only applies to alcohol. So the Enabling Act that set up the local option sales tax was passed by the General Assembly back in 1975. It was designed to replace a portion of the property taxes that local governments relied on. Back then, basically all local government services were having to be paid for through fees and property taxes. The General Assembly felt there was a need to diversify the local tax base, and so the loss was an attempt to do that. It was an attempt to replace dollar for dollar some of the revenues coming from the property tax system. As you can see, no counties immediately enacted it in 1975, but then we had 13 counties that adopted a loss in 1976. And by 1980, we were all the way up to 83 counties that had enacted the law. And then today, we have 147 of the 159 counties that have a loss. So as you can see, that's the vast majority of them. And again, some of these have an education loss. So if you look at the 147 plus the 7 that have the education lost, that only leaves 3 without any loss, and then 2 that have a host. Through a local constitutional amendment, counties use loss for education, so we've got 7 of those. Back in 1975, when it was created, there was a formula that was embedded in state law that dictated how the money would be allocated between counties and cities. It was a population-based formula. The cities got a share based on their incorporated population. The counties received a share based on their unincorporated population. However, the counties would use their share only to roll back property taxes on the unincorporated residents' property tax bill. They would not use any of that revenue to roll back county property taxes inside the city. So city residents received all of their rollback from their city. So what that did is the county general M&O levy in those cases would be a considerable amount lower in the unincorporated area than it was in the city. Well, as you can imagine, there were several cities that did not like the fact that city residents paid a much higher county property taxes because they didn't have the county loss rollback. So they sued, and it went all the way to the Georgia Supreme Court. And in 1979, the act was ruled unconstitutional. First of all, they said 2 things. 1, there was no authority for counties to even share this revenue with the cities. And 2, they said there was no authority for counties to roll back the county M&O levy in the unincorporated area and not countywide. They said the M&O levy was a single levy and it should be uniform throughout the entire county. And as you know today, we do have a few situations where the county M&O levy is less in the unincorporated area because of insurance premium tax rollback. However, that was put in the Constitution, so that has constitutional protection. It's the only thing that we have in Georgia that would allow our revenue to roll back only on the unincorporated part of the county M&O levy. After it was ruled unconstitutional, the General Assembly came back in 1979, and they obviously did not want the tax to terminate across the state because it would have meant large increases in property taxes. So they recreated the tax as joint county-city tax. They required the county to roll back whatever share they received and lost to all county residents, including those in the city. And at the time, there was no mandatory renegotiation. So this was just, it was done very quickly. There wasn't a lot of time. I think GMA and ACCG tried to get together to propose a new formula for splitting the money. That was not successful. So in the interest of keeping the tax and not having it terminate, they went ahead and passed legislation to keep it in place. After that, though, there was a recognition that there needed to be periodic renegotiations between counties and cities because things change. Cities may annex areas and pick up new populations. Population growth may be different from one area to another. Services that counties and cities are providing change over time. And so for a variety of reasons, there needed to be an update to how the loss was allocated between counties and cities. So in 1994, the General Assembly came back and they required in law a periodic renegotiation. And they put also in law 8 criteria for consideration during the negotiation. Now, there was an immediate renegotiation after this law took effect. But going forward, the renegotiation period would be every 10 years after each census. And they would have a 2-year window after each census to complete the negotiations. So there was an immediate renegotiation after the 1994 law, and then the next negotiation took place in 2002. The process in 2002 is if you fail to renegotiate before the end of that year, the tax would terminate. So the tax would go away, and both counties and cities would lose out on that lost revenue and have to make it up through increases to the property tax. The legislature in 2010, leading up to the next round of negotiations, which were done and at the beginning of, had to be completed by 2012, recognized that the 8 criteria didn't work very well. They were very subjective, and they felt like that there needed to be some other fallback other than the tax terminating. So they created, the General Assembly created this judicial arbitration process. And that was basically a process that said if the counties and cities can't agree on new distribution percentages, that they would put it up to the judicial arbitration, and the judge would basically hear both sides and make a decision on which side they felt like was had the greatest justification based on the 8 criteria, and they would have to select one side or the other. They weren't supposed to split the difference. It was like a baseball-style arbitration where they could only pick one side or the other. But the courts came back in a Supreme Court decision, said that was basically an unconstitutional dedication of taxing authority to the judicial branch, and said that judicial arbitration was not constitutional. And so we had to scramble around in 2013 and make sure that all those counties and cities that use the judicial arbitration process, and there was about over 30 of them, had to renegotiate and refile certificates with the State Department of Revenue, and most of them just went back to the old percentage allocation. And so leading us up to today, ACCG and GMA are in current negotiations over what do we do to create a better fallback process. In other words, the next round of negotiations that will occur will have to be completed by 2022, and if we don't change state law, then we go back to the old process of if you fail to negotiate, the tax just terminates and goes away. Obviously, depending on the type of negotiation, and it's different in every county in the state, usually one side or the other has the advantage, and they use that to their advantage. They say, we can afford to let the tax terminate if you don't give us what we want. And you know, we get situations where that gets used and held over the other side's head. We would prefer to have a process that doesn't potentially create a situation where the tax would terminate. And so we're looking right now at sort of fallback formulas. So if they fail to reach a consensus and an agreement, there would be some kind of fallback formula in law. That's in the works. We hope by the end of this year to come to the General Assembly with a recommendation. Again, with local option sales tax, the important thing to remember, it is a permanent tax. It does require the periodic negotiation between counties and cities. It's really supposed to be to pay for annual operating costs that would otherwise have to be paid for with property tax. So it truly should be an offset against property tax. Although some people will argue that as the sales tax has grown over time, there hasn't been a dollar-for-dollar rollback. Counties and cities are required to show a rollback on the property tax bill. If you're in a lost county, you should be able to get out your property tax bill and see exactly a dollar amount savings that you receive for paying that 1 cent extra sales tax throughout the year. Because it does apply to all types of property, and obviously the high dollar property many times is commercial and industrial and agricultural lands and other non-homesteaded properties, the money really gets sort of spread fairly thin once you share it between counties and cities and apply it to all types of property. So in a lot of cases, as far as the property taxes on your home, you may get a 10 to 15% discount by having the lost in place. And we'll talk later about host, which is targeted primarily towards homesteaded property and provides a greater discount on homesteaded property, but it obviously does that at the expense of other types of properties. The next tax we want to talk about is the county SPLOST. It stands for Special Purpose Local Option Sales Tax. Obviously, you can see by this map that it's very, very popular tax. Just about all the counties in the state levy this tax. Now, DeKalb and Fulton have never been able to levy this tax because they have the MARTA tax, and we are capped in Georgia at 2% county-city local option sales taxes. So the education SPLOST does not count towards that cap, and the T-SPLOST does not count towards that cap. But all the other local option sales taxes are capped at 2%. So because DeKalb and Fulton have a lost tax, the one we just talked about, and they have the MARTA tax, they're not even eligible to have a SPLOST tax. Now, there has been some legislation, even this year, that's been considered in the General Assembly to give DeKalb that authority to call for basically a SPLOST. I'm sure that'll come back up next year. And then we have a couple of jurisdictions across the state that are eligible to have a SPLOST for various reasons, just have not passed it, or it's expired and they haven't been able to renew it. So the special local option sales tax was passed by the General Assembly back in 1985. 12 counties enacted the law in 1985, and 16 counties enacted the law in 1986. By the end of 1990, we were up to 103 counties, and then today we have 151 counties that have a SPLOST. As I mentioned earlier, all but 2 counties have had an active SPLOST at some time since its authorization in 1985, and the 2 counties, as I mentioned earlier, that haven't ever had an active SPLOST are DeKalb and Fulton because of the MARTA tax. This is a little bit different from the LOST. The LOST is truly a joint county-city tax. This one is a county tax. It can only be called by the county. We did add some provisions in 2004 that require some mandatory sharing with the cities, but it's not technically a joint county-city tax. Before 2004, the county could actually call for this tax, and if it were to pass in a referendum, it would be levied countywide, and they were not required to give any of the revenue to the cities. The cities in leading up to 2004 obviously wanted to have some more of a guaranteed share put in the law, so there was a major overhaul of the SPLOST law in 2004. It reestablished the tax as a special tax district, and it also required the sharing of this revenue with the cities. There's a couple different types of projects that can be taken off the top. We classify these as level 1 projects, and these are constitutionally mandated type capital projects such as courthouses and jails. And then there's what we call level 2 projects, and they're limited. Only 20% can be taken off the top for level 2 projects. And you can't do level 1 and level 2. It's one or the other. If you've got level 1 projects, then you take whatever you need off the top and then share the rest with the cities based on a population formula. If you don't have any level 1 projects, then you take up to 20% off the top for level 2 projects. And these are any types of projects that are considered countywide in nature. And it could be a city project or a county project, as long as it has a countywide benefit. And you can take 20% off the top for those. And then the remainder would get split based on population. This is a default formula. It's not required to be used. It's only used in situations where counties and cities don't reach a consensus or an agreement on how to split the money. If they have an agreement on how to split the money, then none of this matters. They split it however they want to split it. But in those situations where the city is asking for something and the county is not willing to go along with it, then the county could proceed under this default formula. And again, they can call for the referendum without needing the assistance of the city. How can the tax be used? This is a restricted tax. It has to be held in a separate account. It can't be commingled with any other revenues of the county and city. It can only be spent on the capital projects that the voters approve. Now, there's been a lot of discussions over the year about how strict or loose you define capital projects. And what I'll tell you is the courts have been pretty liberal in their interpretation of this. A lot of you probably think a capital project is very specific. You're probably thinking, a fire station at the corner of X and Y. Well, the courts have said it doesn't have to be that specific. It just has to give basically the voters sort of general knowledge as to what type of project it'll be used for. So a lot of jurisdictions, what they do, it's more function-based. In other words, they'll say X amount of dollars set aside for public safety improvements, or X amount of dollars set aside for road, street, and bridge improvements, or X amount of dollars set aside for recreation improvements, and not base it on any one project. So they can spend it within that category. Other jurisdictions do put very specific projects down on the ballot, and they may do that to make sure that future elected officials that may come behind them don't change the projects. So if you want to really guarantee that a certain project gets built, then you need to be more specific in the resolution and on the ballot. However, if you want to allow for a lot of flexibility to move money around within a project category, then you can be very general, and the courts have upheld that. There also is a renewal period with SPLOST, so it's only a temporary tax. And then if you want to continue it, you have to go back to the voters and put forth another set of projects and get approval. The way that the renewal period works is if you have an intergovernmental agreement with the cities, then you can go up to 6 years. And it's a full 6 years regardless of the dollar amount that's collected during that time. If you do not have an intergovernmental agreement with the cities, then you can only go 5 years, or till the dollar threshold that's placed on the referendum is reached, whichever comes first. There are two exceptions to that, though. If you do not have an intergovernmental agreement with the cities and there's level 1 projects that consume more than 24 months worth of anticipated revenues, then you have to go a mandatory 6 years. And if there are level 1 projects that consume less than 24 months of revenues, then you have to go a mandatory 5 years. So I know that's confusing, but let me restate that. So the default is if you don't have an agreement with the cities, you only get to go 5 years or till the dollar threshold that's stated on the ballot is reached. However, if there's a level 1 project on that ballot, then the rules change. It's a mandatory 6 years if it consumes more than 24 months of revenue, or it's a mandatory 5 years if it consumes less than 24 months of revenue. Again, most people look at that and say that's pretty strange to force somebody to go a certain time period, but that's what the current law requires when level 1 projects are included. There is a required, these funds are required to be audited. There's an annual report that has to be published at least once per calendar year by the counties and cities utilizing these revenues. Another thing that we hear a lot about is what's the time frame for utilizing these revenues. Current law does not have a required time frame. These revenues, in effect, could be held indefinitely. Most people obviously think that once the revenue is collected that the capital project construction will start, but there are situations where, for whatever reason, this money gets held for years and years and the capital projects aren't built. Now, the law says you have to eventually build the project one day, but it doesn't say when you have to build it. So I know some situations where the money's been held for 10, 15, 20 years. We did add a provision to the law a few years ago that does allow for a county or city, when there's a situation where a project's no longer feasible to do, for them to go back to the voters in a future referendum. It has to be as part of a future SPLOST referendum. It's a separate question on the ballot, but they can ask the voters to basically abandon the project, and then that frees up those revenues to be used for property tax relief. Again, that does take voter consent, and that may be why some of this money has remained in accounts for long periods of time. There may be situations where they, for whatever reason, decide it's not a good idea to move forward on the project, but they haven't had a mechanism to dispose of those funds. So there is a current provision in law that does allow for a mechanism to dispose of those funds with voter consent. The county has to call for the negotiations with the cities and give the cities a chance to come forth and give a list of projects that they'd like to see on the ballot. And then after those negotiations finish, they make a decision whether there's a consensus there and they can enter into an intergovernmental agreement, or if there's not a consensus, they then would have to move forward under the default formula if the county chose to pursue the SPLOST without an agreement. The next tax I just going to briefly touch on is the education SPLOST. The rules basically are the same for the education SPLOST as they are for county city SPLOST. It's obviously restricted just to capital projects. However, as you determine, the schools have less capital categories, if you will, than the counties and cities. It's basically just restricted to school capital. And the courts have been pretty restrictive with what type of capital. It's basically the buildings. Anything off campus is not eligible. We've discussed for years the potential of using education SPLOST for road improvement projects. That may be crosswalk signalization, sidewalks next to the school. In other words, those transportation-related projects that are directly attributable to the school, but the courts have said no, that's not an eligible expenditure because it's not on school property. So primarily funding school buildings. As you can see, another very popular way to fund capital. And I will say the education SPLOST and the county city SPLOST have become the primary ways to fund capital at the local level. I assume historically before these SPLOSTs were in place, the counties, cities, and schools set aside a certain portion of their budget for capital. But with these taxes in place today, very little is set aside in excess of the SPLOST for capital. So if these SPLOSTs were to go away, there probably have to be some pretty significant property tax increases to make room for a revenue source to pay for capital. So this tax was authorized by the General Assembly in 1996. This one thing that makes this different than the county city SPLOST is this was enacted through a change to the Constitution, where the county city SPLOST was just a general act of the legislature. Why this is important is because when you want to make changes to the school SPLOST, a lot of times you have to do that through another constitutional amendment, which is a lot larger hurdle than changing county and city SPLOST through a act of the General Assembly. 64 counties adopted the SPLOST in 1997, and today we have 156 counties that have an SPLOST. All but 2 counties have had an SPLOST at some time since its authorization in 1997. So again, recapping the major local option sales taxes, the most common grouping of local option sales taxes is a lost, a county city SPLOST, and an education SPLOST. Most recently, we have the T-SPLOST. This was the first attempt to try to do sales tax collections and expenditures on a regional basis. There was a referendum that was held in every one of the 12 regions in the state. These regions are based on, I think, the DCA regions. Only 3 of those regions, though, passed this tax. And this is a dedicated tax for transportation. There's a component that requires 75% of it to be spent on regional projects, and then 25% of it can go to the counties and cities for their local needs. And that 25% that's split between the counties and the cities, based on basically the same formula as we split elevated dollars on, can be used both for operations and for capital when it comes to transportation. So again, authorized in 2010, the referendums held in 2012. We have a total of 46 counties that have enacted the T-SPLOST. And this is in addition to that 2% cap that I was telling you about earlier. So the regions that have a T-SPLOST could go as high as a total of 8% when you add the state 4% sales tax, the education SPLOST, the 2 local pennies for counties and cities, and this T-SPLOST. And so in a lot of those counties, we do have an 8% rate right now. And as also I mentioned, everywhere except for the Metro Atlanta region, 25% of that money is set aside for not for a specific transportation capital project, but to be used at the discretion of counties and cities for funding whatever transportation needs they have, capital or operation related. Homestead option sales tax. This is like basically the variation on the local option sales tax. It's a more targeted sales tax for property tax relief. It was enacted primarily for DeKalb County. DeKalb County had several failed attempts at passing a lost, and their legislative delegation came back and really pursued the host tax. It was enacted by the General Assembly back in 1995. And the reason you don't see a lot of other counties that have a host is because you can't have a host and a lost at the same time. So all of those other counties across the state that have a lost, the only way they would be eligible to go out to referendum for a host would be to first have a referendum to terminate their lost tax, which is extremely difficult, if not impossible. To have that referendum, you have to have the consent of the counties and the cities, and you have to go to the voters and put it on the ballot, and it has to pass. And then you'd have to have a separate referendum to enact the host, and by the time that you were to start collecting host revenue and providing a homestead exemption, it could be several years lapse. And in that lapse period of time, obviously property taxes would go up on everybody. So for primarily that reason, you don't see a lot of other counties that have a host. Now, the 3 counties that don't have a lost, which are, again, Gwinnett, Cobb, and Cherokee, they could easily go out to referendum for a host or a lost. They've got that choice that they still can make. So what sets the host apart from a lost? Well, the primary thing that sets it apart is it generates about the same amount of revenue per year as a lost tax does. But it targets all of that money towards tax relief on homesteaded property. So instead of rolling back commercial properties, industrial properties, and all the other types of properties, it's taking all that money and putting it towards the homestead exemption. So in a lot of counties, they can completely wipe out county property taxes on homesteaded property with this tax. Now, the law says a minimum of 80% of the revenue has to be spent on the homestead exemption, but it does allow for up to 20% to be set aside for capital. Again, that was probably put in there for DeKalb County because remember I said earlier that they, because of the MARTA tax, aren't eligible for a SPLOST, so they really have no funding source for capital, and this was probably an attempt to give them some money that they could use for capital. But it's restricted. No more than 20% of the money can be set aside for capital. There is no mandatory sharing with the cities, at least on the 80% homestead exemption. There was some language that was put into law when some of the new cities in DeKalb were created that does require some mandatory sharing on the capital part of that. So the part that 20% part that's reserved for capital, they do have to share with the cities. It does require a passage in a local referendum, just like the other local taxes do. One thing that's unique about the host, though, is the Board of Commissioners working with the cities can call the referendum without any need to go to the legislature. Same with a SPLOST. But with a host, because of the homestead component to it, there has to be a local act passed by the General Assembly prior to putting that out to a local referendum. So it's like a two-step process. You got to get the local delegation to pass the local act first, and then you can that then sets up your referendum, and you have to have it passed in a referendum. We have some other specialty taxes across the state that only apply in a few places. Again, MARTA only applies in Fulton and DeKalb. As you all know, that's for transit. The Atlanta water and sewer tax is the only one in the state that applies to just a city boundary, and it's very specific. It can only be spent on water and sewer capital projects. And we have this public safety sales tax in Columbus, Muskogee. That was recently passed. That's the only one in the state we have of those. And then we have this sales tax on only alcohol for school funding in Habersham County, which is unique. That covers most of the local option sales tax. I'd like to now talk real briefly about some things that apply both to local and state sales tax. Things that when the General Assembly is considering legislation, there needs to be a discussion between both the locals and the state on these issues because they do impact the revenues at both levels of government. First of all, there's been a lot of talk about the number of exemptions we currently have in state law in regards to sales tax. There's almost 100 exemptions in the current law. These exemptions are the exclusive authority of the state legislature. In other words, counties and cities cannot make a decision to exempt certain items from sales tax. Anything that gets exempt from sales tax has to be done through a change to state law. Now, those exemptions can apply to all the local sales taxes and state sales taxes, or they can be restricted and only apply to certain local taxes or the state sales taxes. In other words, you can create an exemption at the legislature that would only apply to state sales tax, or you can create an exemption at the legislature that would only apply to one type of local option sales tax. But within the state sales tax or within each one of the local option sales tax, the tax base does have to be uniform. The big thing that's, I think, missing from our tax base when it comes to sales taxes, or the big area where there's a lot of revenue that could potentially be generated if we want to expand the sales tax base to, say, offset income taxes one day, is in the area of services. We do not tax a lot of services. We do tax some services in Georgia, but most of them are exempt. There are other states, such as Hawaii and others, that tax services to a much greater extent than Georgia does. And as you all probably know, the services are a faster growing segment of our economy than tangible goods. And so over time, as the services continue to outpace tangible goods, that's an area where a significant amount of revenue could be generated. However, we've looked at this some in the state of Georgia, and I think one of the difficulties is how do you determine what services are appropriate for taxation? In other words, how can you make sure that people won't go outside the state to receive those same services? Services, by their very nature, can be delivered across many different platforms, including the internet. And so I think you have to be careful that it's some kind of a service that won't push businesses outside the state of Georgia if you were to tax it. But that is an area within our sales tax structure that can be looked at to look at generating more revenue from our sales tax. Another area that is growing is internet, what they call internet sales tax. I want to be clear here, though, when we say internet sales tax, we're really just talking about sales taxes generated from internet sales by businesses that don't have any physical presence in the state of Georgia. Most of these internet sales are usually with companies that do have a physical presence in the state of Georgia. So in other words, if you were to go to Home Depot's website or Kohl's website or any major corporation's website that has bricks and mortar stores in Georgia and buy something over their website, they are required to collect our state and local sales tax and remit our state and local sales tax. So the bulk of that is getting collected. It's the internet companies that don't have the bricks and mortar stores like Amazon and others. Those are the ones that are not required to collect our sales tax. The sales tax is still legally due. It's due through a use tax. Nobody ever pays it. So as those online transactions become more popular and as more businesses move to that model without having bricks and mortar stores, that could present more revenue loss for our state. But again, that's something that we really need Congress to deal with to make that uniform across the entire United States. Differences between state and local sales tax bases within Georgia. The biggest difference is what we call food for off-premise consumption. This is a lot of the food items that you would buy in the grocery store. It's not exempt from the local sales taxes, but it is exempt from the state sales taxes, and that could be a significant difference in the two tax bases for state and local. The other major difference is natural gas used in the production of electricity.
I have a question from Pat Gardner.
Is there a question from Pat Gardner?
No, sorry.
Differences among local options within Georgia. There's a few differences among the local. Most of the local options have the same tax base. But for instance, one new difference is education splost and education lost are currently being charged on energy used in manufacturing. The state sales tax and all the other types of local option sales taxes were exempt from energy use in manufacturing. That, of course, that's a phased-out approach. So we're phasing those out. But once those are completely phased out, some people have said we're not charging any sales tax on energy use in manufacturing. That's not true. We will continue to charge the E-SPLOST and the E-LOS. Now, for most counties, that's going to be just a 1% tax because all they have is an E-SPLOST. But we do have, again, 7 in the state that have the E-LOS. And so in those situations, manufacturing would continue to pay a 2% sales tax. T-SPLOST is another one that's a little different. We charge local sales tax on motor fuel for all the other types of local sales taxes except for T-SPLOST. With T-SPLOST, it is not applied to the sale of motor fuel. So when you go to fill up at the pump, you're going to pay not only the federal excise tax and the state excise tax on gasoline, but you're also going to pay the state sales tax, which 3% goes into DOT's budget and 1% goes into the state general fund. And you're going to pay, in most cases, up to 3% local option sales taxes on motor fuel. Now, those are collected at the wholesale level, so you will not see an itemization of those on your receipt, but those do get passed on to the consumer in the price of that fuel that they pay. Differences among, let's see, some new exemptions to the sales tax base recently. Obviously, we had GATE, which not only incorporated a lot of the previously exempt agricultural commodities, but it also expanded on those exemptions to allow some things that had not previously been exempt, like parts in the repair of equipment and other things to be exempt. So in the rural areas, they've seen some decline in their sales tax revenues, primarily because of the use of GATE. Also, it's an easier program to utilize and access, so a lot of people did not want to utilize the prior program because it was cumbersome, because they have been utilizing the new GATE program. And then energy used in manufacturing, as I said earlier, the state sales tax and most of the local option sales taxes are being phased off of energy used in manufacturing. And then, of course, vehicles, we took vehicles out of the sales tax base and replaced that with the new title ad valorem tax. But these are all things, obviously, that impact both state and local sales tax. And when they're being debated at the General Assembly, the local governments have an equal interest in those policy decisions. There's also been a lot of discussion about what information is available to local governments about their local option sales tax from DOR. There is what we call a commodity code report. This categorizes sales tax into broad categories such as automobile sales, which would include not only the sale of an automobile, but also parts, parts stores, anything related to car sales. You know, there's a category that deals with sort of grocery store sales, another one that deals with convenience store sales. I think there's about 8 different commodity code categories. And so you can kind of see by looking at the commodity codes what areas of your sales tax are up and what areas of your sales tax are down, which gives you a little bit of a sense of what sectors in your local economy are doing well or not doing as well. But it doesn't give you any kind of detailed information on specific businesses. We can find out who's registered to pay sales tax in Georgia, but some businesses register under they have stores across the state. They register under a category that does not tell the local governments all the different counties they're registered in. And so that's problematic to know if they're registered in your county or not. So there's very limited information you can get from the sales tax registrations. All you know is that they have signed up to collect and remit sales tax. You don't know if they're remitting any sales tax or how much they're remitting or where they're remitting it to. We did attempt to provide the Department of Revenue with some additional local information to make sure that businesses that were required to register with them were signing up to register for sales tax. This is called the Business Occupation Tax Submittal System. It's local counties and cities that submit their business occupation tax data to the Department of Revenue, and the Department of Revenue can use that to check to see if they're also signed up to collect sales tax. So they basically look at the industry classification code and determine if it's a business that would likely have to collect sales tax, and if they're not registered in the state system, then they will investigate and determine if they are required to pay sales tax or collect sales tax, and then they could force register them. But the information flow is from the local level to the Department of Revenue. There is not information flow back down to the state level. In other words, the local governments still don't know if a business is collecting sales tax in their jurisdiction or not. So for a good example of this, recently I had Cherokee County was asking about a new retail store that's on the Cherokee-Bartow Cobb line, Cabela's, which is a pretty big store that just opened up. It's got an Ackworth address. The city of Ackworth is located in Cobb County, so they were concerned that the sales tax may go to the wrong county. So they asked the Department of Revenue, can you tell us if Cabela's is paying the sales tax to Cherokee County? The Department of Revenue said that's confidential information. All we can tell you is that they are registered to collect sales tax. So the Department of Revenue could not tell them if they were collecting sales tax and and where that sales tax money was going. Now, by Cherokee alerting the Department of Revenue to the issue, hopefully the Department of Revenue will check and make sure that the sales tax is going to the right county, but they cannot tell the county government that. That is confidential information. Audits and refunds, the Department of Revenue can tell counties and cities of the monthly check they receive, how much of the revenues came from audits and refunds. That could be an addition or subtraction to that monthly check, depending on if they're having to pay businesses that overpaid or businesses that underpaid. Obviously, it would be an addition to that check. Again, registered vendors, a lot of them, like the stores that have locations across the state, will sign up under a master account, and so the counties aren't really seeing that they're registered in their particular county through the business occupation tax process, because with the Department of Revenue, they're under a master account, so all the money rolls up. They still have to account for their sales taxes based on the sales that occur in each county, but they don't have an account for every county. It all rolls up into one single account. So there's very little information, I guess, that local officials can get from the Department of Revenue. That's been discussed at the General Assembly also, and I'm sure will be discussed again in the future. What should local governments have access to versus what should be kept confidential? Obviously, the business community has an interest in making sure that that information that could help a competitor doesn't leak out. So businesses don't want their competitors to know exactly what they're generating in sales tax, because that would then tell them, what they're generating in sales. So for those reasons, the business community is also very interested in this topic.
There's a question. Why are sales tax collections confidential information?
Okay, the question, why are sales tax collections confidential information? State law. That's it. State law exempts this information from open records and requires the Department of Revenue to keep it confidential. So any change to this area would require change in state law. In other words, when we did the business occupation tax middle system, we were able to send them information, but they can't, again, in turn send us information. Basically, the only information under current law that they can give us is they can tell us if a business has registered to collect sales tax, and that's about it, because that is a public document. But how much they're collecting and where and what jurisdictions they're sending it to, or how they're allocating the pot that they collect between different jurisdictions, that is all confidential information. Okay, I think we have about exhausted our time here today. I hope that this has been helpful to you. I think we have a couple more questions, and then we're going to end. What's the next question?
The question is, why not allow for intragovernmental sharing? Share between state and local government.
So why not allow for intergovernmental sharing? Well, obviously, we do allow for intergovernmental sharing at the local level. Counties and cities share SPLOST and LOST, but I assume the question is talking about the sharing between, say, state and local, where the state would give the locals a share of the state sales tax. That can be done. I guess one of the concerns is always if there's that type of sharing taking place, if we run into difficult economic times, would the sharing be changed to adjust for budget difficulties? For example, there are other states that have sales taxes that are shared between the state and local levels, and what we've seen when the economy went downhill, the state stopped sharing a lot of that revenue with the locals because they needed it to fill holes in their budget. So that would be a concern from local government standpoint. Again, how the sharing would take place, but we don't currently have any sharing between state and locals. There's also been a lot of discussion at the legislature about fractional pennies, allowing for the locals to not have to levy a full penny, but to levy some percentage of that penny. That made its way through the House this year, and it's stalled in the Senate. I'm sure that discussion will come back. So you can obviously regulate the amount of revenues two ways. You can regulate the revenues by time, so you can shorten the length of time to collect less revenue or extend the time to create more revenue. The other way to do it would be to adjust the rate to limit or expand the amount of revenue it would bring in.
And also sharing sales tax information between state and local government.
Well, I know both GMA and ACCG would like to see more sharing of information between state and local government. We feel like there's advantages to both the state and locals if we share more information. There's probably a certain amount of sales tax that is underreported, and then some that's not reported at all. And the more we share information, the better chance we're going to have to discover those situations where revenue is not being reported accurately. But we have to do that within the context of keeping a system that's fair to the business community. So there's probably an issue that we need to continue to discuss. We probably need to have maybe some meetings set up between the local government associations, the state, and the business leaders like the Georgia Chamber of Commerce, and maybe decide, what truly should be kept confidential, but what information would allow for local governments to assist the state with ensuring that sales taxes are collected appropriately. Because I assume that the business community wants to make sure that all their businesses compete on a level playing field. So if there's current loopholes in the law or areas where it's easy to evade the collection of the sales tax, that could really put some of their businesses that are obeying the law at a significant competitive disadvantage. 7% tax rate when you combine state and local in most places is a pretty significant margin. And so I think anything we can do to make sure that everybody that should be collecting taxes is actually collecting it and remitting it would help the business community. And again, trying to do that while keeping information that could be potentially used for competitive advantage confidential.
Next question. What are the pros and cons of discontinuing the host tax?
Well, to discontinue the host tax, because it is a permanent tax like loss, there would have to be a referendum. I guess the cons of discontinuing the host tax would be your property tax on homesteaded property would go up dramatically. Again, as I said earlier, a lot of these counties, I think Rockdale County this year gives 100% homestead exemption, so you basically pay 0 county property taxes. And if you were to do away with a host, you would go back to paying county property taxes, which on a $200,000 home, that could be $600 or $700. I guess the pros in doing away with it, obviously you'd have one less sales tax to pay, so your sales tax rate would decrease by 1%. It would also open the door up to a loss tax if you feel like a loss tax is better than a host tax. And again, the main difference is with loss, you're spreading the tax benefit over all types of property, commercial, industrial, and everything. So everybody gets a little bit of a benefit, but it's not targeted to homesteaded property. Some of the people that advocate for host, they say that, homesteaded property where your primary residence is located. It's not income generating property, and it doesn't always, the rise in value and taxes of that home aren't always in lockstep with your income, and therefore if we're going to protect somebody, the people we ought to be protecting are people that the homes they live in, that they can't generate necessarily income off of. And these other types of property, they do have means available to them to generate income. So that's what I've heard as far as some of the arguments for the host over a loss. But I'm sure the business community would prefer a loss over the host because they get some property tax relief out of a loss where they really don't get much tax relief at all out of a host. But both of those taxes, again, are designed to provide property tax relief. It's just how that property tax relief is targeted. Okay, I think that's all the questions we have. I hope this session has been helpful today. Again, my contact information is available on this last slide. We did record this, so we will make it available to anybody that was not able to participate. If you know of other people that would have liked to have participated but just couldn't today, they can go to our website and they can listen to a recording of this webinar today. And we'll also email it out to everybody, the link to that webinar. And if you have any suggestions for future webinars, please send that to my email address. We are looking for other topics. I know one of the things that with criminal justice reform and juvenile justice reform, we'd like to take some time to talk about sort of state responsibilities versus local responsibilities for the criminal justice system. That's a topic we're going to probably do in the near future. But there's a lot of other topics where state and local governments work collaboratively on providing a service to the public. Most recently, we had title ad valorem tax, which, as you know, our tax commissioners do the tag and titling work and collect that tax, but the states receive benefit from that tax. And the titling and tagging function is a state service. So there's a lot of those types of joint type services that we'd like to cover in future sessions. And I hope that these sessions help when issues come up at the legislature and there's policy discussions taking place to have sort of that context from a local government perspective. Again, if you have any suggestions, please email those to me. And I appreciate you attending the conference call today and look forward to you participating in future conference calls. Thanks.